Well, welcome back to Noobs Noobs. It is Monday. It is March the 2nd. This weekend, we started a conflict with Iran. So we got oil and gold acting a little funny. Ironically enough, silver down really big on the day. It was up last night pretty heavy, but it's now down on the day. Um, the market was down about 60 or 70 points last night when I last looked at it. And it is a bunch to do about nothing because the market is pretty flat today. Recovered all that fear, all the selling in the equities, back to pretty much unchanged across the board. Gold still, like I said, up 60. Oil was the story for last night. Oil went kind of crazy, got all the way up to 75 and some change, almost $76. Gave most of that back. It's up about 350 right now to $70.51. So first thing you're going to see is that on your screen, you see that big yellow thing that says call alert immediate action required. Click on that little arrow. So probably because of the big down move last night, at some point when we went from last night to today and it registered as a new day, you must have had a maintenance call because of some of where these positions were marking out overnight. But right now you can see that your capital that's available to you is $2,400. You're fine. You don't need. What that means is you don't have enough capital in your account available to maintain the position. So at some point during that dip, you got to where you would have had to make some adjustments. You did have that happen last week towards the end of the week as well. So I actually had to close out on Friday of all days. On Friday, I closed out your those longs in oil, and of course, this weekend we do all that stuff with Iran. So they would have been nice winners last night. You would have been up like $1,000, $1,500 in that one position alone. But I closed it out, so my bad because of capital. So that's what happens when you get too big. You close things out for capital reasons instead of closing things out for just thinking they're a good trade. Because I still like the oil trade. Wouldn't have closed it out if it wasn't a matter of needing the capital elsewhere. What I did use the capital for was actually buying some Oracle stock in there for you. So when Oracle dipped down, it's actually pretty flat. But I bought you some shares of Oracle. If you open up Oracle, you'll see I have a little bit longer of a position in there now. You got 100 shares in there as well as all the other stuff. And then I sold the 150 call against it. So you've got that 150 call marking at $13, and it's pretty close to 150. So pretty aggressive covered call in there with a lot of premium, giving you a bunch of protection to the downside. All right. So I think we're going to let you do it today, kind of go through your positions and just briefly say whether or not you think they need to be adjusted and explain where the risk is and what type of position they are. We'll go one by one real quick. So to know whether or not you bought something or sold something when you're combining options together, right? So we got one that's short and one that's long. The easiest way to do it is to look at the one with the most value. Is that long or is that short? If it's long, that means you bought that strategy. You're long in that strategy. If it's short, you sold the strategy. Because what is that? What do I mean by that? So if I am long something that costs $1.50 and I sold something that costs 25 cents, what's my overall risk in that? Did I take in a credit or did I pay for the overall strategy? Bought something that cost $1.50, sold something that cost 25 cents. I paid $1.25. So I'm long. I bought the strategy. If I pay for a strategy, I'm buying the strategy. If I take money in when I put a strategy on, I'm selling the strategy. Okay. I'm long a vertical spread. Or I'm actually long 10 vertical spreads on a put. You're buying the option to buy the stock at $2.50. At the same time, you're selling an option guaranteeing someone else's right to buy it back from you at $5. So if I have the option to buy something at $2.50 and I'm saying I'll get rid of it at $5, the most it can be worth is $2.50, the difference between $2.50 and $5. Right? Mm-hmm. But that also costs me something because I had to pay a debit to put that strategy on. So if it cost me, I don't remember exactly what it did cost, but if it cost me $1.25, what's the most profit that I can make on expiration? Something that has a potential value of $2.50, but I paid $1.25 for it.
So $1.25?
Yes. So it's basically a 50-50 shot. Risk one to make one. Okay. But it's better than a 50-50 shot because you have short premium working in your favor. And at the time that I put this on, I think the stock was trading close to where it's trading now, and the break even was somewhere around $3.68, I think it was. So that means it's a little bit better than a 50-50 statistically probability of success. All right. You've got shares. Do you have calls sold against the shares?
Yes.
Okay, so you know you got some covered calls in there.
Yeah.
Okay.
calls.
Okay, so 3 covered calls. That only leaves you 1 more short call, and then 2 long options. So we just covered what that was: a long call and a short call combined, same expiration. That's what?
Spread. What is it called? I forgot the name already. Vertical spread.
Yes. Yeah, it's a vertical spread. So you have 1 vertical spread, and then you're just long a naked call. You're just long a call. You can look at it like that, or at the time when we put these on, you see how there's 2 7.5s and 2 12.5s.
Mm-hmm.
Those were put on as a vertical spread that was $5 wide initially. So those 2 were 2 vertical spreads initially when they were put on, and then the 10 short call and then the other 10 short call were part of a covered call strategy initially when they were put on, and then we must have had a call that expired worthless because we still have 100 uncovered shares in there. That's fine though. I don't think you do anything in there. I think Webull has earnings coming up very soon, like in the next couple weeks, or maybe even this week. I can look. Hims, what do you got in Hims? The update in Hims, coin. Oh, that's coin. Short put. Yep. It's actually working now. This is the one where we covered the covered call strategy, and then we covered the covered call strategy, and we put on just a short put instead because it was more capitally efficient. Okay.
Hymns.
This is the inverted one, remember?
Yeah. That's where you keep moving it until you go.
Upside down to where your short call is lower than your short put. I think we still give this more time. I mean, we're still leaning basically almost completely long in here, so we just keep letting that work.
Bitcoin.
Coin's working fine today. You may want to consider into this up move, maybe rolling these marches out to April, because there's not much value left in those contracts. $7 credit, but you also moved your short by $5, so that's fine. I think you still have another short in there. I think you have another 50 that needs rolled. Go back and look. Yeah, there's 1 more short 50 in there. Okay. There you go, filled. There, that's adjusted. Moving on.
MP. Sold a put. Sold
Oh,
call.
we're up to our short at this point. Are we making money today? Yeah, you're up to $1,000. You're inverted. You're in 2 different expirations. I say we buy both of these back and we reestablish.
How can you tell so easily like all the different things? I look at this and it's just like bunch of
Because
numbers.
because you need to be the one that is working with the positions. So I have all these positions. I could tell you what positions I have on in my head without even looking at the screen. I could tell you where my risk was just because I'm the one who established it. And I thought about the risk before I put it on.
Midline.
Huh?
Mid price.
Yeah, that's fine. And buy the other one back. So the reason we're doing this is because we're at the highest profitability that we've been in this position all year. So the strategy is at its most working place, and we're getting very close to our short strike on the call side. We're only $1.50 away from it. So we're right at a place where we can basically buy the guts and sell the wings. So now we'll go back into April. Back into April, and we'll uninvert and put on a regular strangle. So just do like a 20 delta strangle. So go over to your delta and look, where's 20 delta? That'll put you at 55. There's 24 delta, 55 on the put side. Is that one of those? You gotta scroll further to the left. You scroll. See the 24 delta on the put side? Is that one of those? Huh? That's the call side, but okay. It's still 23 delta. That's fine. We're gonna sell one of them too. We're gonna do 20 delta on both sides. So the 80 and the 55. Nope. That's 85. Not 55 delta, the 55 strike. Yeah. No, that was right. And go ahead and hit next. $4.70. Okay. Doubt you'll get filled there, but try. Oh, you did. Okay. Excellent. All right. So now you're uninverted. You have about $5 in credit in there. And your new break evens are going to be close to the $50 to the downside and 85 to the upside. So you're leaning pretty much delta neutral. You know that because what did you sell? You sold the 24 delta on the put side and the 23 delta on the call side. So your overall delta in here, if you scroll to the right, should be 1 or less. There it is right there, 0.3. You have 0.3 delta. So you're neutral, totally neutral. All right. MU, another one that is working today. You're finally in the green in this position. I don't think you touch anything. Netflix, here's another one. You can see that there's one that I've already adjusted this once today. See where I rolled up? You had the 92 put, and I rolled it up to the 95 put. So now you're short a 95 call and a 95 put. They share the same strike, so they're not a strangle. They are a what?
Straddle.
A straddle. So I think you do the same exact thing in here because it is working today, not a bunch. Keep in mind, you're in the money now, or you're being tested to the upside. You have $550 of unrealized losses. We're going to go ahead and realize those losses by closing this out. Go back into they're both in April, so just go into the options chain. Bye.
Can I just close selected?
And then go to the 105.
Oh,
Wait. In April, yeah. And then sell like the 105, and then no. And then go down. The other down, yeah. And then sell the, what does the 90 look like? Yeah, the 90. That will give you about 500 and, okay, $600 total. Yeah, try that.
So we're just making for their part.
Buying the guts, selling the wings, reducing our risk.
I don't think that failed.
It didn't. Just leave it. Leave it till we're done. Then you can readjust.
Video, so put.
This is NVIDIA had earnings. There was a big down move on the earnings, so I just tried to take advantage of the momentum to the downside and sell puts into strength. So like when things are going down, you get more money for selling puts because that's where the momentum is pumping premium. So it's still kind of flat. It really hasn't worked. I don't think you just leave it. Oracle. This one has earnings coming up, not the end of, I think it's at the end of this week, beginning of next week. Silver, this, what kind of strategy is this? I put this on as well. And I don't think we didn't do it on the show.
So we have a put, bought a put, sold a put. Sold a call and bought a call. Is it a strike? 2 strangles?
It is 2 strangles. It's a long strangle and a short strangle, but they're combined. You can look at it that way because technically it is, but you would never call it that. It has a name for the strategy. It's also 2 other things. What other things is it? The things that we just discussed. It's 2 verticals too, right? So you got a vertical spread. You got a 95, 105, and then you've got a 70, 60.
So it's a lot of things?
Depends on how you choose to look at it. But I mean, the name of the strategy is called an iron condor.
I was going to guess that actually. I don't know what it means, but I was going to guess it.
Well, where is your risk?
Truthfully, I don't know. I don't understand how to determine your risk.
Which of the contracts have more value? We know it's 2 vertical spreads, right? So which sides have more value? The short put, but yep. And then on the other side, which of those 2 contracts has more value?
The other side, the short call. So both the shorts.
So the shorts have more value. So that tells us right off the bat that we sold this strategy, right?
Okay.
So when we sell a strategy, just like when we sell a strangle, we want the stock price to stay in between the shorts, right? We don't want the stock price to move through the shorts. This is the same exact thing. It's just we also bought protection. So look at it as if you have a short strangle with $10 wide wings that offer you protection. So the most that you can lose is that $10, either direction, up or down, minus whatever you totally collected for the credit. So in this case, we sold this for $2.50. So $10 minus $2.50 is $750. So unlike a strangle where you can lose infinite to the upside and all the way to 0 to the downside, this you've defined your risk and you can only lose up to $750 because you took in $250 and you bought protective wings $10 wide. So the worst that this thing can do is be worth $10 on expiration. You keep your $250 and buy it back for 10. So $750 is your loss. So an iron condor is just a strangle with protection. Make sense?
Pass.
Oh,
Yeah, I'm here. Hello?
does that make sense?
Yeah.
What kind of spread is this? This is a vertical.
Vertical
Again, a
spread.
vertical spread. Yeah, is it a long vertical or a short vertical?
Long.
Remember, why is it a long vertical? How did you determine that?
37. It's higher than 31.
So at least you got that part down. Okay. There's only, you need to have like a cheat sheet because there's only,
Cheat sheet, 'cause I don't remember.
we'll have Chat GPT just put,
I suck at definitions.
you don't even have to know the names of the strategies as long as you understand where the risk in the strategy is. Unity.
Just sort of. But
Yep, just a short put. And you can see that, remember, year to date, we talked about this last time. That means this had to have been rolled at some point. But now your overall year to date P&L is actually in the green, so it's working. So you're back to where you need about $5,000 more in P&L in order to be back in the green. But you're moving in the right direction. I don't know what you did there. Must have lost connection. So to recap, you never got filled in your Netflix. So go back and adjust your Netflix, get that filled before we close out here. And I don't think we do anything as far as putting more orders on.
it's replaced. 602.
Still didn't get filled. So before you put this through, you see how it's a four-legged spread here that we're doing? For 605. You see how it's a four-leg? You have on the left side. What kind of? Yep, you're buying one and selling one, creating what?
A vertical spread.
Yes. What do you have on the right side?
Another vertical spread.
Right. So even though you don't have a four-leg strategy on because you're closing one and reestablishing another, this, as we put this through, would be considered by the system an iron condor because we're transacting four different options. We already have two of them that are going to be closed out and replaced with two new ones. But the way that the system is looking at this is we're putting an iron condor on. Actually, this would be because the strikes in the middle share the same strike. It wouldn't technically be. We wouldn't call it an iron condor. We would call it an iron butterfly because they share that same strike. But effectively, what are we doing? We're buying back a strangle and selling a strangle. So that's what, like when you were talking about your iron condor earlier, and you said, well, it's two strangles basically. Yeah, that's true. It is two strangles, but it's also two verticals, and it's also an iron condor. So adjust the strangle, and when you adjust the strangle, buy it back and resell different wings, you're actually trading an iron condor in order to make that happen. Right, a good solid update today. What's weird about the overall market today? See if you can tell me something that's kind of an anomaly that doesn't typically happen. When you look at all the equity indexes, which would equity indexes would be the Nasdaq, the S&Ps, the Russell, and the Dow.
Wait, which ones?
The Nasdaq, the S&P 500, the Russell, and the Dow. So MNQ, MES, M2K, and MYM.
They're all up.
They're all up, except for the Dow is down a tiny bit. But like, what typically happens? What's the relationship between equities and volatility?
Hey.
When the market goes up, does volatility go up or down?
Down.
And when the market goes down, volatility goes up or down.
Up.
So what's their correlation? Are they?
What do you mean? Like when one goes up, the other goes down.
So that's an inverse correlation, is what that is. So they behave opposite one another. They're inversely correlated. But what do you see happening in the VIX today?
They're both up.
Yeah, the VIX is up, the VIX futures are up, and the market is up. So that's an anomaly. That tells you, because they're inversely correlated. The normal behavior you should expect would be when the market is up, the VIX is down. When the market's down, the VIX is up. Today we're seeing market up, VIX up, and that's solely due to the geopolitical risk of the war that's popping off in Iran. So even though the market is up and people aren't super worried, they're still pricing in like uncertainty into the future. Just wanted to point that out. it doesn't necessarily mean anything in and of itself, but it tells you that the market is behaving in a way that it normally wouldn't, which should give cause for a little bit of concern. Like that's something that I would be keeping an eye on, and I would want to see the market behavior come back into like a normal behavior. And it could give you an idea of, usually when you get that type of inverse behavior or an inversion of the relationship, oftentimes it'll happen before the market changes directions on like a broader time frame, which would mean that the risk would be to the downside for right now, because we've been in a bull market for quite a while. Doesn't always happen, but it's something that the longer you do this, the more you notice things like that which one of these things is not like the other. This is not behaving as it should be. And that could be a little flag that goes up in your head. But all right, that's all I got, unless you got any other questions.
Nope.
Thanks for watching, everybody. Don't forget to like, subscribe, coming out with us in the Discord. We're doing some, like I said, we're doing some cool stuff. It should be actually launching this month. So check us out. Check out the link in the bio, coming out with us in the Discord, and see what we're doing. And you can come on some of these episodes if you want. We'll have you on as a guest. All right, peace.